High gas prices, high food costs, inflation, it's everywhere. Prices are getting higher and financial markets are tanking. But I want to let you in on a little secret. And if you've followed me for a while, you already know this. Stocks and options traders can absolutely crush it right now if they know what they're doing. Hi, I'm Robert Roy of WealthBuildersHQ.com, and we teach traders technical strategies to build their wealth using financial markets. In this video, I'm going to walk you through what's happening in the markets from a technical standpoint. And then we'll discuss a few strategies that will help you turn an economic recession into a potential economic opportunity. So let's start off by looking at some technical analysis of the S&P 500. We're going to get into some current market conditions of what it's looking like and so forth by going right into the chart. So you can see my chart of the SPX right here. We've got a lot of major technical data on here. So I'll give you an example. There's a Fibonacci level drawn right in here down to here, right? We had a clean V top down to a nice V bottom. We had a good push up and a fail. We had this double bottom pattern that pierced through, gave us just about a 20% correction from the lows of the day. We popped back up. We got into this dreaded box of neutrality is what I call it. And then from there, we just fell out of bed and we hit 20%, 21%, and so forth. We were just dropping like a rock on the S&P 500, right? All of this relating back to what's going on right now. War with Ukraine, the high gas prices, the high food prices, the insane credit card debt that people are in right now. Yes, it may be lower than it was the beginning of COVID, meaning as COVID first hit and people were out of work, they were getting no money. Many people had to put monies on credit cards. We've paid a lot of that debt down, but we are way over where we should be right now as far as costs, right? The decisions that the government is making, this love-hate relationship of spending money versus taxing rich, right? Which we're not doing any longer, right? And it's pretty clear if there are federal taxes on your gas, the government is still taxing you. No matter how poor someone may be, they're taxing them ridiculously right now. Oh, let's not forget the 8+% inflation rate. All of this having a dramatic impact on the S&P 500, right? Dragging it down drastically. So when you look at the charts right now, you can see this huge move, 20% to the downside. I'm going to flip over to a different chart right now, still the S&P 500, but each one of these candles represents a monthly activity, 1 month of data inside of there. It's the first of the month to the last day of the month. And what I'm going to do is I'm going to scroll back, and I want you to see back here, this is what happened in 2020, right, at 19 to 20, which was after, of course, COVID hit, right, that big move. We had a great gain inside of there, right? But if we keep bringing it back, and keep bringing it back, and keep bringing it back. And what I'm looking for is, actually, these are all weeklies, my bad. Let's go grab the monthly chart. So each candle here is a month. The other ones were weekly, not weekly, right? So here we had this great run, right? Y'all remember Y2K? Some of you are like, Y2 what? No, Y2K. 2000, right? Computers were running out of data. It was 1998, 1999. Oh my goodness, there's nothing to flip over to 2000. Change all the software. The world's coming to an end, right? Well, at the same time, we had the dot-com bubble burst, right? And we crashed in 2000. So if you look, here we had this wonderful run into Y2K and then this crash in 2000, right? Ran into about 2003. Then we got this nice gain, came back, which brought us into late 07. And there's where we had the housing debacle. Bubble, debacle, stupidity, governments letting it happen, housing people letting it happen, right? And that crash took years to come back, right? The expression I used to use, because I've taught events, seminars, trainings on the market since 1997. So I've been around for all of these, right? And the expression was, does your 401k feel like a 101k, right? It's been drastically cut so bad. 50, 60% drop in your portfolios were taking place back there, right? Well, but Rob, we're so much higher than we were. That doesn't mean that the market's not going back down, right? We're getting smacked right now for multiple reasons, and we have not seen the bottom, in my opinion, yet. There's no capitulation. VIX has not gone where it needs to go. VIX is the fear factor. It hasn't hit the levels that it needs to. We don't have the, oh my God, I'm throwing my hands in the air, I'm done, go to cash. We don't have that right now. There's not the fear that we need for capitulation. We need the last of the last, all of the Robin Hood investors that know nothing about the market, but someone told them they should throw some money at it. Those are the ones we need to give up for the market to start to turn. But we're seeing something happen right now, well, some of it that we haven't seen in decades, and interest rate hikes, which I'm okay with hikes. We need them. We are late to the party, way late to the party. We should have done interest rate hikes long before. I don't like the Fed's position, and we need to wait for this to raise interest rates. No. We make adjustments based on this, not on, I need 9 months of data before no, that's not what we're doing. Period, the end, I think we make a mistake. To the point that we had to raise 0.75% after the last month saying we weren't going to do that. And now there's a very high potential that we raise 0.75% again. Why? Because we're late. Oh, play catch up. Boom, boom, boom. It's kind of like your 401k. After 50 or 55, you can put more money in, right? Because you're older, you get an extra $1,000 a year, as if it's going to matter anymore at that point, right? But it's a makeup, a catch up, as it were, right? So when we look at the S&P right now, and we look at the markets, and we look at inflation, and we look at what's going on with interest rates, right? We're having serious issues with what's happening, right? I listened to one economist today talk and say, you know, we're about 14 days away from where we're doing this recording, which takes us into Juneteenth, which is this Monday, and then it takes us into 4th of July, right? And all of that, and we're about 14 days away from the U.S. finally waking up and going, oh my God, I can't afford it any longer. Because so many people right now are at the gas pumps and they're putting 20 bucks in their tank at a time. See, it doesn't feel so bad when you just drop 20 bucks in, right? When I go to the gas station, I drop 70 bucks in to fill a tank up, right? Sean, who's on the other side of our recording right now, with his truck, 70 to 100 bucks to drop in gas into his truck, right? And I've had students tell me it's 150 to fill their trucks for business and so forth, right? It's expensive. But what's happening is you're going to go on these long road trips. You can't drop 20 bucks in and hope there's a gas station coming up. You need to fill that puppy up. And when you fill it up, people are going to realize, oh my goodness, look at the cost here. I just don't have it, right? When we look at the conditions of 2000, 2008, we're setting up on the same types of things right now, right? We were going with a top-down approach where we gave the money to businesses and we push it down to individuals, and that's where we see the increase taking place in the markets, right? Well, what's happening now? We're doing it the other way. We're pushing it down to individuals and expecting they're going to spend it, and it's not happening the way that the government thinks it's going to happen, and it never does. Every time we get into this kind of an economic model, we fail. Historically, we fail, right? Again and again and again, and that's where we are. S&P down over 20%. The Dow is about 20%. The NASDAQ is over 30%. The top 5 companies in the NASDAQ are 40%, more than 40% of the NASDAQ are 5 companies. You realize the NASDAQ is 100 companies, and 5 of them, 5% of them make up over 40% of the value of the NASDAQ 100, right? It's insane. Right? So some of these techs have gotten too big. They've gotten their heads cut off a little bit in the last little while now, but we are not in a position yet that things are going to change. There are factors you need to pay attention to, like inflation. You've got to know what's going on there. You want to look at things like CPI, Consumer Price Index, right? What it costs you to buy something. PPI, Producer Price Index, what it costs somebody to make something. Fed interest rates, all of these are important. And folks, you can't tell me you're not seeing it out there. Look at how much things have gone up. There's a restaurant that we love to go to, and we got the bill, and my wife she scrutinizes everything, right? She goes through the bill and says, ma'am, every one of our meals are more money than we paid, than were on the menu. And the woman said, yes, prices have gone up. And she said, but you don't have that listed in the menu. She goes, we can't print menus fast enough to keep up with the price changes, right? True story. My wife's not very happy about that place right now, but bottom line, it is what it is, right? Notice that there are more companies now passing credit card charges along to the consumer. A restaurant we went to the other night, my oldest daughter got engaged, right? Congratulations for her and her fiance. So we took them out for dinner when they got back from their vacation, which they were away when he proposed. And we went to the restaurant. We go all the time to this place. We're known very well there. And it said, very well worded, we're giving you the prices reflected in this menu are based on a cash discount. If you choose to pay with an electronic payment form, you will have a 3.5% increase in the cost on your bill, right? Okay, right? You're seeing more and more charges, things that are hitting like that. You've got to pay attention to all of these factors out there. How many people do you know right now that are cutting back, right? That are not doing the things that they would normally do, trying to save? Small businesses, I know many of them are not spending money the way that they were. They're holding back on those monies, right? Because they're afraid of what's going to happen over the next little while and then potentially a couple of years for us to start to see some changes there. So from here, let's go take a look at some key, and I mean key technical indicators that you want to focus on when looking at the S&P 500. For me, it starts off with Fibonacci. There's no ifs, ands, or buts, whether it's a daily, a weekly, a monthly. They all have Fibonacci's drawn on them. They are critical. But beyond the Fibonacci's, we focus on, I'm going to take you back to a daily chart. We focus on a series of Fibonacci numbers that are derived from a Fibonacci number series. 1 plus 1 is 2, 2 plus 1 is 3, 3 plus 2 is 5, 5 plus 3 is 8, and so on and so forth. This 4181, this very dark black line right here, where I am right now, 4181, that is a critical Fibonacci level. We had hit it, we gapped below it here, we came back up. We double tapped it here, we got a little bit of a bounce. We ran up to the highs, right? From there, we collapsed, we hit it, came above, closed above, pushed back up, and that was our first big fail. Another double bottom, came back to this box of neutrality, which ended the tops at the 4181 level, and then we've collapsed off of there again. Are we going back to it? At some point we will. Are we going back today? I don't know, right? But there are other fib levels that you definitely want to snap on your chart. So that one, 4181, 4181 is that fib level. I'm going to scrunch the chart down, make it a little bit busy on the screen, right? That brown line is important, but I will explain to you why in a moment. The next major fib line is right down here at, looks like 2584 is our next level, 2584, right? And this brown line in between is 3382.5, right? Sorry, the lines are really small, the numbers. I got to shoot over to see them. 3382.5. It is the distance between those two black lines. That's why I drew it in brown. It's a different color, right? It is critical to me as a trader that I know where those levels are. They must be on my charts. Am I anywhere near hitting that black line? No, but we ain't that far away from the brown one that's coming up, right? We're right there in essence, right? If we're sitting at 3667, we'll call it. I don't like 3666. So let's call it 3650. Make it easy math. Versus 3350. We're talking about 300 and change points away from getting down to that next level. Can we do that? Well, how about this? How about if we go over, let me escape out of that. Let me shift to a different chart. Still the S&P daily. We move 102 points a day. How flippin' hard is it going to be to get down to that brown line? Think about it. It's not, right? But you've got some decisions to make at that line. That is a key level. Support, resistance, it's critical that you know it's there because the stock is going to stop in that area and most traders are going to sit there going, why? What does it mean? It means nothing to me, right? So those fib lines, critical. Exponential moving averages, right? The normal, short, mid, and longer term moving average for the average person, here's the average, 10, 20, 50. Why? They're easy to remember. They're whole numbers. That's the only reason they ever came about, right? Well, I go a little bit deeper than that, and my exponential moving averages are Fibonacci levels. Remember that number series? 1 plus 1 is 2, 2 plus 3 is 5, 5 plus 3 is 8. 8 is our very first moving average, right? 8 and 5 is 13, right? 8 and 13 is 21. 21 is our next Fibonacci moving average. And then I'm not going to do the math, but 2134 is 55 is our third one. So 8 moving average, 21 moving average, 55 moving average, all exponential, right? And those are when I'm looking at my shorter term charts. When I look at my longer term charts, I have two moving averages that I use. The average person uses a 50 and a 200. Why? Because, again, easy math, easy to remember in my head. Not the levels I use. I use a 55 simple moving average, and I use a 233. A two what? 233. I was driving in Texas with a good friend of mine, Bill. We were teaching an event together in Texas. He lives there. And we're driving down the road, and we were talking about moving average. And I said, he was saying 5,200. What do you use? I said, I don't use the 50 and the 200. I use the 50 and the 233. Now, we're in his sports car, and all of a sudden, it's kind of, what the hell are you doing? He's swerving over as he's looking to talk to me. What do you mean 55 and 233? Explain yourself, right? Lucy, explain yourself. What's going on, right? Guys, to me, they're better levels. If you use a 50 and a 200 and you like them, use them. I am not trying to change your mind. I am letting you know what it is that I do, right? There's a reason that in our power option plays, following the rules that we did, we are 7 times increase in our sample trades. We're up 700% this year from the start of the year. And all of it comes back to how we use technical analysis. Now that you know what traders might be expecting and watching for, what opportunities does a bearish market offer traders? Well, if we look at the different strategies, you've got directional positions. And for me, with options, I'd be looking to purchase put options. Remember, with a put, when the stock goes down, the value of the put goes up. All right, so we would look to just purchase directional put options. But I am a huge fan in these types of markets of selling premium. Things like credit spreads, diagonal puts, naked puts, right? If you're getting bullish moves, which, think of it, do we have some energy stocks going up? We could bring in some credit? Yes. So let's talk a little bit about each of them. Credit spread. Why do I like them? The market maker is overvaluing options because the VIX is up. So because of that overvalue of the options, I'm getting to sell that premium, take that in as cash, and then the market maker tends to strip that premium out quicker in this type of market. And when I buy it back, I could buy it back for a very small amount. Our news strategies day in and day out are, which I teach a live training every day, Monday through Friday, 8:30 to 9 a.m. Eastern, called Market Mornings with Robert Roy. It's on our YouTube channel. I'll leave a link down or the description down below that you can check it out, right? We're on multiple platforms with that. But the credit spreads are the strategy we focus on very heavily when it comes to news trades. Diagonal puts now are a strategy that's fairly new to the Wealth Builder HQ of environment here, to our database, our students, right? I've been trading them for years. It's not something that I've taught. Why? Because we've been in a bullish market. It's not something that's been a steady diet. It's not that you're going to go and have alligator once in a while or kangaroo or something like that you're going to eat, right? You're talking about it's pizza, it's a hamburger, it's a hot dog, it's an everyday thing. In a bullish market, diagonal puts is not an everyday thing. Today, diagonal puts is an everyday thing. Here's some of the goods and bads with them. Because the VIX is higher and your main focus in that trade is to buy a long-term put and sell a short-term put front week, you are going to have a much higher cost in comparison to the diagonal calls right now. And I do both of them. I share both in our Covered Call Explorer. And if you want to see these folks, I'll leave a link in the description down below. Go check it out. There's a 2-week trial that you could see the diagonal puts, naked puts, the diagonal calls, covered calls, iron condors on the rut, all of that. But I'll leave that link down below. But when you look at that diagonal put, we're spending a lot more money for the longer put that we have to purchase right now. Because of that, there's a much greater cost. But my payoff, my risk in the trade is much reduced because I'm also receiving a larger premium on the position that I sell. Now, when you look at naked puts, it really has to be very strictly, there's a sector that's moving up, energy as an example, right? When we're going from $90 in oil up to $120 in oil, right? You're moving up. There are positions that we could sell naked puts on. And once again, collect higher premium as a seller than if we go ahead and buy a call option for that. So what you want to do is trade the market at hand, right? Basically, you want to trade in the market's direction. 70 to 80% of all stocks move in the direction day in and day out with the S&P 500. So if you're a newer trader, or you tend to get on the wrong side of things easily. Don't ever trade against the market. Don't do the naked puts in a bearish market, ever. Focus only on the direction of the market. If you do that, just that alone, you dramatically increase your odds of being right in the trade, right? And sometimes the only thing you can do is say next. You pass on that trade. Next is the trader's most valuable word. It's the most important phrase you could ever learn as a trader. Pass on the garbage. Just focus on the good. As of this recording, markets have only recently dipped into the official bearish territory. Investors are going to feel some hurt at this point, but traders, this can still offer plenty of opportunities for potential profit. Until next time, make it a profitable day. Stay focused on the quest to becoming a great trader. Keep crushing it. And remember, you're just one trade away. Go ahead and click here to check out some of our other trainings.